All right, everyone, let's dive into the fascinating world of business cycles. These are the ups and downs in economic activity that we see over time. They're like the heartbeat of the economy, influenced by a range of factors such as population growth, technological advances, capital investments, expectations, political events, natural disasters, and fiscal and monetary policies. You might also hear about credit cycles, which are the ebbs and flows in the availability and cost of credit. These often move in sync with business cycles. Today, we'll break down these concepts and understand the theories behind them. So, what's a business cycle? Simply put, it's the recurring expansion and contraction in economic activity that affects the major sectors of the economy. These cycles are typical in economies based on business enterprises, not so much in agrarian or centrally planned economies. A business cycle usually follows a sequence of phases, upturns followed by downturns, and these phases occur across the economy at roughly the same time. It's important to note that while cycles are recurrent, they aren't periodic. This means each cycle's intensity and duration can vary. Generally, the duration of a cycle is between 1 and 12 years. A business cycle is divided into two main segments with two turning points: expansion or upswing. This is the phase where economic activity is increasing. Think of it as the economy's good times. Contraction or downturn. This is the phase where economic activity is decreasing, the bad times, if you will. The turning points are peak and trough. Peak is the highest point of the cycle. Trough is the lowest point of the cycle. All right, now that we have a basic understanding, let's move on to the different types of cycles. There are three main types of business cycles: classical, growth, and growth rate cycle. Classical cycle involves fluctuations in the level of economic activity as measured by GDP. The contraction phase is typically short, starting from a peak and ending at a trough. The expansion phase is longer, starting from a trough and ending at a peak. Second is growth cycle. Here, we look at fluctuations in business activity around the long-term trend growth level. The focus is on whether economic activity is above or below this trend growth. This type of cycle divides economic activities into long-run and short-run trends, with peaks reached earlier and troughs later compared to the classical cycle. Growth rate cycle involves fluctuations in the growth rate of economic activity. Compared to the other two cycles, this cycle recognizes peaks and troughs earlier. Now, in practice, the definitions of business cycles can be somewhat ambiguous and often used interchangeably. The classical cycle concept isn't used much these days, but the growth cycle concept is frequently employed to identify fluctuations around potential output. For instance, let's say the economy is growing at a steady rate of 3% per year. If the actual growth rate deviates significantly from this trend, either higher or lower, we can identify these deviations as part of a growth cycle. This helps policymakers and economists make informed decisions about monetary and fiscal policies to stabilize the economy. Next, there are four phases of the business cycle. Let's break down these phases in more detail. These are recovery, expansion, slowdown, and contraction. This will help us understand how the economy transitions from one phase to another. In recovery phase, the economy is emerging from a trough, which is the lowest point of the cycle. During this phase, the actual output is at its lowest relative to potential output, but begins to increase. Key indicators during this phase include a rise in consumer confidence, increasing investments, and the gradual reduction of unemployment. During expansion phase, the economic activity picks up momentum, and actual output surpasses potential output. This phase is characterized by increasing spending, production, employment, prices, and interest rates. GDP also rises. For instance, during the expansion phase of the early 2000s, the tech industry boomed, leading to increased production and employment in that sector. During slowdown phase, actual output reaches its highest point relative to potential output, creating the largest positive output gap, which then begins to narrow. Inflation and price levels may decrease, and businesses might rely more on overtime rather than hiring new employees. Consumers, however, remain optimistic. An example of this phase can be seen in the late 2000s when economic growth slowed down before the onset of the financial crisis. During contraction phase, actual output falls below potential output. Consumer and business confidence drops, leading to decreased employment, overtime, and economic activity. This phase is usually shorter than the expansion phase, but can lead to a recession if prolonged. For example, the Great Recession of 2008 to 2009 saw a significant contraction in economic activity globally. Let's take a deeper look at 3 significant events in economic history to illustrate these concepts further. The first is the dot-com bubble and its aftermath, as we briefly discussed earlier. In the late 1990s, the dot-com bubble represented a classic expansion phase driven by technological innovation and speculative investments in internet companies. During this period, stock prices soared, employment in the tech sector increased, and there was significant investment in new technologies. However, as we moved into the early 2000s, the bubble burst, leading to a contraction phase. Many tech companies went bankrupt, stock prices plummeted, and the economy entered a recession. This period highlights the cyclical nature of business activities and the impact of speculative bubbles on the economy. Second is the 2008 financial crisis. The 2008 financial crisis provides a clear example of the interplay between business and credit cycles. Leading up to the crisis, loose credit conditions and financial innovations like subprime mortgages fueled a housing boom. As housing prices soared, economic activity expanded, and the economy entered a boom phase. However, when the housing bubble burst, it triggered a severe credit crunch. Banks tightened lending, businesses cut back on investments, and consumer confidence dropped sharply. This led to a significant contraction in economic activity, high unemployment, and a deep recession. The recovery phase that followed involved substantial government interventions and monetary easing to stabilize the economy. Now, the third and the most recent one is COVID-19 pandemic. The COVID-19 pandemic caused a sudden and severe contraction in economic activity worldwide. As countries implemented lockdowns and social distancing measures, economic output fell sharply, leading to a trough phase. Governments and central banks responded with unprecedented fiscal and monetary policies to support businesses and households. These measures helped to stabilize the economy and set the stage for a recovery phase. The pandemic highlighted the importance of timely and effective policy responses in managing business cycles. Another aspect to consider is that different sectors of the economy can be impacted differently during various phases of the business cycle. For instance, during the expansion phase, cyclical sectors like consumer discretionary and technology tend to perform well as consumer spending and business investments increase. In contrast, during the contraction phase, defensive sectors like healthcare and utilities might perform better as they provide essential goods and services that remain in demand regardless of economic conditions. Investors can use this knowledge to adjust their portfolios based on the anticipated phase of the business cycle. Now, this is a very important part of the CFA exam, so it's important that you understand these business cycle stages. Now, let's discuss how investors can benefit from forecasting changes in the business cycle. Understanding these cycles helps investors make strategic decisions to optimize their portfolios. Let's dive into the different phases of the business cycle and how they influence market conditions and investor behavior. First, we have the recovery phase. This phase occurs when the economy starts to rebound from a recession. During this time, we see increased economic activity and improving economic indicators. So, what does this mean for investors? Investors tend to become more optimistic. Risky assets like stocks and high-yield bonds become more attractive. People are willing to take on more risk because they anticipate higher returns as the economy improves. Next, we enter the expansion phase. Here, the economy is growing and businesses are thriving. Firms may increase their production capacity and face a shortage of workforce, indicating robust economic health. Investors see this as a prime opportunity to invest in growth stocks and sectors that benefit from increased economic activity. However, it's essential to stay cautious as the economy can overheat, leading to potential corrections. Moving on to the slowdown phase. This is when the economy's growth starts to decelerate. Despite higher stock prices, bonds become more attractive due to their lower prices and relatively safer returns. Investors might shift their focus to bonds and defensive stocks. These investments tend to provide stability and preserve capital during uncertain times. Finally, we have the contraction phase. During this period, the economy contracts, leading to a recession. Investors become risk-averse and prefer safer investments. In this phase, investors typically turn to bonds and stocks with stable cash flows. These assets offer more security and are less volatile in a downturn. By understanding and forecasting changes in the business cycle, investors can adapt their strategies to optimize returns and mitigate risks. Each phase of the business cycle presents unique opportunities and challenges, and being aware of these can significantly enhance investment decisions. All right, let's move on to credit cycles. Credit cycles refer to fluctuations in the availability and cost of credit, which are crucial for business investments and real estate. These cycles can amplify the effects of business cycles. When the economy is strong, lenders are more willing to extend credit. When it weakens, they tighten credit. Recognizing the stage of the credit cycle can help assess business expansions, housing market growth, and policymaker actions. For instance, during the housing boom of the early 2000s, loose credit conditions led to a significant increase in housing prices. However, when the credit tightened during the financial crisis, it caused a sharp decline in housing prices and economic activity. Loose credit conditions can cause asset price and real estate bubbles. The duration and magnitude of recessions or recoveries are intensified and affected by financial frictions, which refer to variations in access to external financing. The relationship between business and credit cycles is critical, as credit cycles tend to be longer and deeper than business cycles. For example, the prolonged credit expansion during the 2000s led to the housing bubble, and its subsequent burst caused a severe recession. Understanding these dynamics is essential for making informed investment and policy decisions. In this section, we'll explore how economic indicators evolve over the business cycle, focusing on three key areas: workforce and company costs, capital spending fluctuations, and inventory levels. During contraction phases, companies tend to retain their workforce, but as the phase prolongs, there's a shift towards liquidating inventories and cutting costs, including advertising expenses. Capital spending decisions, vital for any business, are influenced by expectations, business conditions, and capacity utilization. A critical indicator for assessing changes in inventory levels is the inventory sales ratio, which measures the stock of unsold goods against sales, providing insights into whether inventory levels are appropriately aligned with sales trends. Understanding these dynamics is crucial for anticipating economic shifts and making informed business decisions. Indicators provide insights into the state of the economy. There are three types. Number one is leading indicators. These change before the overall economy and predict short-term future states. Examples include stock prices, new orders for durable goods, and the unemployment claims. Leading indicators are valuable for investors and policymakers as they provide early signals of turning points in the economy. Second type is coincident indicators. These change with the overall economy, reflecting the current state. Examples include GDP, industrial production, and employment levels. Coincident indicators are useful for confirming the current phase of the business cycle. Third type is lagging indicators. These change after the overall economy, showing past conditions. Examples include unemployment rates, consumer prices, and corporate profits. Lagging indicators help confirm long-term trends and the effectiveness of economic policies. Composite indicators. Composite indicators are economic indicators that measure the cyclical state of an economy by combining various economic and financial measures that consistently show a leading, coincident, or lagging relationship to the economy's general cycle. The Conference Board, a U.S. industry research organization, publishes the Conference Board Leading Economic Index, LEI, a composite leading indicator consisting of 10 component parts, using the classical business cycle as the underlying concept. Now, let's talk about the uses of economic indicators. Organizations like the OECD create composite leading indicators to measure business cycles across countries and facilitate comparison. Economic tendency surveys conducted by central banks and other institutions use composite indicators to gauge financial conditions and future confidence. These surveys typically include qualitative questions about finances, level of activity, and confidence in the future. The advent of big data has increased the variables used in composite indicators. Nowcasting, a blend of now and forecasting, involves monitoring economic conditions in real time, like GDP growth and inflation. GDP Now is an example of using current data to forecast GDP for the ongoing quarter. This approach helps policymakers and investors make more timely and informed decisions. For example, during the COVID-19 pandemic, Nowcasting techniques were used extensively to monitor real-time economic impacts and adjust policies accordingly. Understanding business cycles is crucial for CFA candidates as it helps in analyzing economic activities and making informed investment decisions. These cycles, influenced by various factors, follow a pattern that can be anticipated with the right knowledge. By keeping an eye on economic indicators and credit cycles, one can better navigate the ups and downs of the economy. We've covered the basics of business cycles, including their phases, types, practical issues, and applications. We've also looked at real-world examples to illustrate these concepts and understand their implications for investors and policymakers. All right, folks, that's a wrap on understanding business cycles. Keep this information handy, as it will be invaluable for your CFA exams and your future careers. Stay curious and keep learning. Remember, if you have any questions or need further clarification, feel free to ask. Happy studying.